Tricon Residential to the Wellington Altus team. So for those who don't know, Tricon does own a portfolio of single-family rental assets, largely in the U.S. Sunbelt. A good proportion of these assets were purchased from the courthouse steps in the wake of the great financial crisis. But since then, Tricon has built an inventory of approximately 31,000 single-family rental homes and multifamily rental units across 21 markets in the United States and Canada. So one of the trends we've observed, obviously, is COVID-19 has forced a de-densification trend where there is a migration away from major urban areas into Tricon suburban-focused single-family and multifamily rental properties. So with us today is Gary Berman with San Francis, Charlotte Tuo-Cucci to walk us through the story. So thank you very much for your time, and we'd love to hear more about Tricon.
Kenny, thank you very much for hosting. Good to talk to everybody. We're going to go through a presentation, assuming a lot of you are new to the story, and then we're going to leave some time in the end for Q&A. So Charlotte, whenever you're ready, if you could share the presentation, I will go through it. Terrific. Okay, so let's start on page 2. If we could do that. So thank you. So we like to think of ourselves as a rental housing company focused on the U.S. Sunbelt and the middle market demographic. Let's flip over to slide 3. We're going to use some numbers to tell our story. So you can see Tricon's been around for a long time, since 1988, founded by my father, David, and his partner, Jeff Matus, both ex-City bankers. We went public in 2010, about 10 years ago, for succession planning purpose and really to help us diversify. But really what we've done is we've gone through a very long journey where we've transformed ourselves from being focused on really for sale housing to really being now a rental housing company, really a landlord and operator. So it's been a big transformation, and that transformation is now complete. You can see that by the numbers. In the middle column, you can see that we own and manage almost 23,000 single family rental homes and about 10,000 multifamily apartments, 31,000 units in total and growing. That's been the transformation since going public. And we're the only company that I'm aware of in the public markets that manage both single family and multifamily. In terms of market cap on a fully diluted basis, we're about $3 billion. We pay a dividend of 7 cents a quarter, which is about a 2.2% yield. And our strategy of really focusing on single family rental in the US Sunbelt has certainly done really well. We've been able to generate an 18% increase in book value per share since entering the business in 2012. Our stock price is kind of ebbed and flowed. It's now moving in the right direction, but I still think we have a little bit of room to gain there on the book value per share. And certainly if you're not in the stock, it represents a very compelling entry point. Let's move over to slide 4 and talk about our team. So this is a team I would say, I like to say really eats, sleeps, breathes residential real estate. We're absolutely passionate about what we do. There's real purity in our mission to help our residents. A few things I would just observe about the team. First of all, these pictures were taken a few years ago when we were better looking, but maybe today a little bit wiser. 2, I think on diversity, this is an area we're really working hard on. It's a real challenge, I can tell you, in the real estate business to get the right diversity. We have a very diverse organization broadly across our nearly 800 employees between, I think, ethnicities and certainly males and females. But at the senior leadership team, we're certainly working harder on the diversity, and it's one of my greatest challenges because I really believe as a leader, when you have a more diverse team, you're able to share more perspectives, and we would be better positioned to serve the residents, our residents, which are obviously extremely diverse. And then the last thing I want to say is this is an incredibly innovative, forward-thinking team. We're always trying to be a leader in everything we do, and that's one of the reasons we've done so well and become, I think, in the single-family rental business, one of the leaders. Let's move over to slide 5. Thanks, Charlotte. So we're benefiting right now. I talked about up front, if you heard me, about being fortunate, but we're certainly benefiting from social, technological, and demographic shifts that I would say have accelerated. We like to think of the pandemic, COVID-19, really as an accelerant. A lot of trends that were in place before the pandemic are now accelerating, and we're really getting the benefit of that in our business. The first one is when we look at where we're investing, which is in the U.S. Sunbelt. There's a great migration really from north, from the Midwest or the Northeast, all the way down to the Sun Belt. And we've always had a demographic-based approach to investing where we believe if we can follow that growth, population growth, household formation, job growth over time, we're going to get more home price appreciation, more rent growth, and more liquidity in our business. So it's very much a belief that demographics is destiny. And right now the Sun Belt is doing particularly well. And into the pandemic, as people search out the safety and serenity of the suburbs and single family housing, a lot of that's trending towards the Sun Belt. Work from home is a really interesting trend. You know, this was something that certainly was viable before the pandemic, but it wasn't really socially acceptable, what we're doing today. And what we found through surveys, certainly with our own employees, it's amazing how productive people are. This kind of great experiment in working from home is worked out better than anyone thought. People are really productive, often happy. And so what we're going to see on the margin is we think more and more people are going to work from home. By no means do we mean that office is dead. It's not binary. But certainly in America, more employers are going to locate to the Sun Belt. More people are going to be allowed to work from home, certainly on a flexible basis. And if you can work anywhere, why not live in the Sun Belt where you've got better weather, you've got more affordability, and certainly lower taxes? So those trends together are going to continue to drive migration down to the Sun Belt. The other thing, the big thing to be aware of is the millennial cohort. We define millennials as those born between 1980 and 2000, actually a larger cohort than their parents, the boomers. And that cohort is now coming into their primary years for forming families and having children. And when they do that, they obviously need more space. So it's almost creating this perfect storm now with the pandemic and millennials coming into their formative years. It's now a great opportunity for them to reset, move out of denser urban areas and into the suburbs where they can raise families. Baby boomers, also a major cohort and driver of a lot of businesses, have now seen through this pandemic that living in a retirement home isn't necessarily that great or safe. And so they're also more likely to stay in home or age in place. And that will again drive further demand for single family housing in the suburbs. The other thing I would say is that the 2010s, the decade after the Great Recession, in many ways was a lost decade for for sale housing. Incredibly difficult to produce new housing. In many cases, it wasn't needed. And so now we come at a point where demand's extremely hot, that there's very little supply, and it's creating that imbalance between demand and supply and leading to really strong home price appreciation and rents, which are benefiting our business. And now, obviously, in the US, you've read about the big stimulus package. There's going to be renter assistance. All of that stimulus and obviously the Fed helping with monetary policy is going to lead the US out of this downturn into recovery. And that, again, is going to create more wood behind our back. So this is setting up a really terrific environment for our business. It's not going to last a quarter, a year. We think we're going to have tailwinds for the better part of a decade. So when I talk about the Sun Belt, this is what it looks like in the US, these kind of darker shaded states. They're also affectionately now known as the smile states because they're in the smile and they're happy again. And you can see this is where our portfolio is located. Really strong overlap, geographic overlap between our single family and our US multifamily rental business, which allows us to achieve synergies. And think about it this way, 40% of the US population lives in the Sun Belt, but they're going to get about 60 to 70% of the growth going forward. Again, as Americans move from A to B, from north to south, in search of better weather, lower taxes, and more affordability, and that growth begets growth. Again, we want to be in the growth states where we're going to have higher home price appreciation and rent growth. And really think about Tricon as an American company with a Canadian ticker. 96% of our rental portfolio is located in the US Sun Belt. Let's move on to slide 7. So not only are we focused on the Sun Belt, we also have this very unique middle market focus. And how we define the middle market is households in the US Sun Belt that are earning between $60,000 and $100,000 per year and can pay, let's say, between $1,000 and $1,800 a month in rent. We've specifically targeted the middle market because they're a more captive resident base where you're going to have less turnover. And we think that the key to winning in rental housing, particularly in single family rental, is to drive a low turnover model. What we found is that when household income gets above $100,000, there's a higher propensity for people to move out and buy a home. And by the way, if you look in single family, our two larger peers, Imitation Homes and American Homes for Rent, do play in that, I would say, that upper end where household income's above $100,000. And that's one of the reasons we believe we've been able to generate lower turnover. And conversely, when you get below $60,000, you have more issues collecting rent. You might need to send a football or a rugby player to collect rent. Maybe a good business in the private markets, but in a public market, that's a very difficult business to run. So one of the reasons I talked about how innovative our team is, and that's kind of a core tenet of everything we do at Tricon. I want to go into a little bit more detail and talk about how we're using technology and innovation to really drive every facet of our operation. If you've ever figured out, well, how does single family rental even make sense? I tried to rent one home and couldn't do that. What happens if I had 100 or 1,000 or 25,000 homes? You come to realize pretty quickly that the technology driving the business is very similar to Amazon or Uber, or Airbnb, where you're really trying to organize extremely complex tasks, right? It's really the convergence of cellular mobility, which allows really access anywhere, broadband speed, and then cloud computing and AI. So that's what's really bringing our business together. And I'm going to give you some examples. So in acquisitions, we've developed our own proprietary software platform called Triad, which allows us to automate the buying of homes through the MLS. So I'm sure you've all used the MLS yourselves if you wanted to buy a home. So essentially, when a home hits the MLS in the United States, we monitor that. We screen that every 5 to 10 minutes. And using algorithmic underwriting, if the home fits all our criteria, we've got about a 90-point criteria, it essentially drops through a funnel. And we have the ability to essentially underwrite that home and produce an offer in less than 5 minutes. So it essentially allows us to automate the buying of home buying, and we're doing about 800 homes per quarter based on the capital we have, but we can dial that up or down depending on the opportunity and the capital. Then the whole process of acquiring the customer once we have the home is also essentially automated. We use search engine optimization to drive prospective residents from different internet listing sites to our website. If they're interested in, let's say, 123 Elm Street, we'll get their information, credit card, driver's license. They can then use our self-show app and go and look at that home within minutes. They take a selfie of themselves. If that selfie matches the driver's license, the door automatically pops open, presto. They can walk in the home. And then if they like it, they close the door, and within minutes, we'll send them a text to allow them to complete the application process. If they're qualified and they move in, we use a virtual move-in service. So you can see that entire process of buying the home all the way to acquiring the customer and having them move into our home is done with technology and virtually. We also have our own repairs and maintenance program or software that we call Triforce, which is an automation business software that allows us to standardize scope and automate workflows across the field and the central office. So we become incredibly efficient with the way we manage repairs and maintenance. In the call center today, we're now introducing bots or intelligent virtual agents so that we can automate the intake of leasing and maintenance inquiries. So you don't have to wait as long if you're a prospective resident with a request. And then we can repurpose our people in the call center to focus on value added or tasks that require more empathy. And another thing we're doing, just as an example, which I find to be incredibly compelling, is that we're now cataloging or asset tagging all the main components in our home. We use 3D mapping technology to track every major component in a home. Let's say a water heater, so we know the serial number, the make, the longevity of that component. And when you have that across the portfolio, you can data mine it, and you can get a very good sense in a given year how much you're going to need to spend on water heater replacement, so you can get more I would say proactive rather than reactive in your maintenance, and then drive your procurement program. So you can see how we're using technology every step of the way to drive this business and allow us to become more and more efficient. Let's move over to slide 9. So this is a capital allocation overview, and it gives you the best sense of where we are today. You can see this great transformation to a rental housing company. 95% of what we do is now rental housing, and where we're going. But you can see today about 75% is single family rental, 20% is multifamily, and then we have about 5% in development. Of that development, 2% is in our legacy business of for sale housing, and that's going to generate about $300 million of cash for us as we sell lots and homes, and it naturally liquidates, and we can use that cash over time to continue to delever or to reallocate that capital into our rental housing business. You may have seen recently that we announced the syndication we sold an 80% interest of our US multifamily portfolio. That was the Starlight portfolio that we bought. You can see the impact of that in the middle column. That shifts the mix. And now 80% of what we're doing is focused on single family rental. And really the vast majority of the capital that we're going to allocate going forward is going to be on single family rental. That's where we see the best opportunity, the best returns, and where we can get the best terms from third-party investors. Okay, let's flip over to page 10. So these are examples, pictures of our single family rental portfolio. This is what you get for, let's say, $200,000 to $250,000 in the US Sunbelt. This might be hard to believe coming from a kind of Toronto context, given we know how expensive homes are here in this local market. We're buying homes for roughly $200,000, and then we're putting in a 10% renovation, which brings the home up to a common standard. So maybe we're spending $220,000, $225,000 all in for a home. So you can see these are really high quality homes in good middle market neighborhoods, good school scores. And one of the key things that we're targeting, certainly compared to our larger peers, is we're really trying to find the more affordable, or I would say the smaller home on a good street in a good neighborhood, right? We're really focusing on neighborhood first. And so it's 1,600 square foot. This is a very compact, affordable home, still a 3-bed, 2-bath that allows our residents to get into the right neighborhood and school district at very affordable rent. Our metrics in single family rental have been consistently the best in the industry. Even though we don't have the scale of, let's say, American Homes for Rent or Invitation Homes, we've had industry leading same home NOI growth, even though I will tell you that we've been self-governing or limiting on renewals as part of our ESG program. Our NOI margin growth has gone from about 57% in 2017 when we bought Silver Bay on the New York Stock Exchange to about 67% today. Massive growth. Obviously, we're seeing terrific rent growth in this difficult time because there's so much demand for our product. And what I would tell you is really where that shows up and where you can see the health of our business is in new leasing spreads. In most of our markets, new leasing growth is double digit, 10 to 15% in a recession, in a pandemic, which goes to show you the amount of demand we're seeing for single family homes. Occupancy at 97% plus, and really record low annualized turnover. This starts to look more and more like Canadian apartment business, but remember in the US, Americans are much more transient. So typically you see 40 or 50% turnover. So these are incredibly low numbers. And I think the main reasons for our industry leading metrics and performance is certainly our culture, our innovative culture, where we go above and beyond to take care of the resident, to our technology that I've talked about. And I think lastly, our middle market focus. Let's flip over. Thank you. Let's talk about our US multifamily rental portfolio. So this we bought from Starlight a couple of years ago. This is a really high quality portfolio in the same Sunbelt markets, the same neighborhoods where we own single family homes. Very new vintage portfolio. You can see some images here. It's a really high quality portfolio that's got resort style amenities. Also caters towards the workforce. It was a little bit harder hit last year because of the pandemic. Again, single family rentals done extremely well because you have that safety and the privacy of a single family home. In a multifamily context, you don't get the same privacy, and in certain cases, you haven't enjoyed the same benefits of the amenities. Maybe they were closed. So multifamily's done well in the Sunbelt, but not as well as single family rental. And our portfolio in particular has had more exposure to Houston and Orlando, which have been tougher markets. So our performance was impacted a little bit last year, but is coming back hard. Orlando and Houston are doing much, much better. Disney World, as an example, is back to 50% capacity. People that are there today feel it's full, even though it's half full. And obviously all those workers that were furloughed or laid off, some of them are coming back, and that's now driving performance in our portfolio. So we went from about 92% occupancy to about 95% today. And we're also seeing much stronger rent growth. So this portfolio is really trending in the right direction as well. Let's talk a little bit more about the syndication of our US multifamily portfolio. We valued this at $1.33 billion. This was the same value as our book value, so in line with our IFRS value. It implies about a 4.7% cap rate. The reason for that is that we've got Freddie Mac, GSE debt on the portfolio that's out of money. when it was put in place, it was very attractive financing, but now that interest rates have come down, it's a little bit out of the money. If it wasn't encumbered with the Freddie Mac debt, probably this would trade at a 4.3% cap rate, just to give you a sense of where the market is, where valuation is. So real upside for us in this portfolio with time, particularly as we can improve the performance, internalize the property management, which we're doing right now, and then ultimately refinance the debt. But you can see this generated $425 million of cash for us at the end of the quarter, and it's allowed us to drop our debt to assets, a key target for Wissam and his team, from about 55% debt to assets to just under 50% today. So this is our long-term target that we've been able to achieve in the last week or two. So let's talk a little bit about our Canadian development portfolio. This is a build-to-core portfolio focused on downtown Toronto. It's a small part of our business, but we're creating an incredibly unique, special portfolio, which one day will be incredibly valuable. And so just to give you a context, we've got one building right now that's operating called the Selby. It's a 500-unit project at Bloor and Sherbourne. And then we've got a number of projects at various stages of development and construction, nearly 4,000 units, all downtown. You can see the map. These are incredible locations, transit-oriented, walkable, and these buildings, when they're complete, will be best in class. So when this is complete in, let's say, a few years, there will be no better portfolio, never mind in Toronto, but really maybe in the world. This is the highest quality multifamily portfolio anyone's ever assembled. We just agreed to a joint venture with Canada Pension Plan that will allow us to grow another 2,000 to 3,000 units, and we could be at about 7,000 units when we're done. And that could provide us with an opportunity, if we want, to lift this or separate, maybe even create a dedicated, Canadian REIT and really generate a lot of value for our shareholders. Right now, it's on our books for less than $1 per share, and just the existing portfolio, when that's stabilized in a few years, we think it's going to be worth more than $3 per share based on existing cap rates. So one of the big things and a certain catalyst that you should be looking out for is our fundraising. We are really seeing, unlimited interest from major institutions to give us money to manage for rental housing, major local Canadian pension plans, but also foreign and American institutional investors are really in real estate now focusing on what they call beds and sheds. Commercial real estate's difficult and uncertain, but there's certainly a lot of conviction in beds, residential, and sheds, industrial. And so because of that, and because certainly in single family rental and certainly locally in Toronto in terms of built-to-core multifamily, there's so few bona fide operators, we're being inundated with interest. Every week, one of the largest institutions on the planet is calling us to say, hey, can we manage money for them? We've been on the other side of that. I know there was a time where we begged for $5 million. So it's incredible how far this business has grown and how fortunate we are today, but we're taking advantage of it. And we told the market that this year we'd raise about $1.2 billion of equity capital. We're about halfway through that already. And so in the next quarter, you should expect us to announce 2 to 3 more vehicles that will allow us to complete that, and hopefully then some, all mainly focused on single family rental. One new venture that will allow us to buy brand new homes, one by one, or in communities from major public home builders or private builders in the US. And then a continuation of what we call single family rental JV1, where we're working with Texas teachers and the government of Singapore to create what we will call JV2, to go out and buy one home at a time organically through the MLS. And with those ventures in place, hopefully within the next quarter, we will be able to go from roughly 25,000 single family homes to nearly 45,000 homes within 2 to 3 years with all that capital locked in. So massive growth and obviously an incredibly compelling time to enter Tricon. So this is our performance dashboard. We go through this on all our earnings calls. It gives you visibility into what the key financial priorities are for us. We go over this every quarter like a Broadway play over and over again. You can see FFO per share is our main priority. We said we will grow this at 10% per annum over 3 years, even though we've significantly delevered. And our goal is to get to 52 to 57 cents in 2022. Everything, by the way, in this presentation is in US dollars. Our functional currency is US dollars. Our ticker and dividend are in Canadian. but apart from that, it's all US dollars. So 52 to 57 cents in 22. You can see we're almost there in 2020. We are deleveraging this year, so there'll be a little bit of short-term dilution, but we're very confident we can hit that target and then some by 2022. And based on that, if you look at multiples, the stock price should be considerably higher. On the third party at AUM, I just talked about what our goals are. We're about halfway there, and we think we'll hit the 22 target actually next quarter. So significantly ahead. I've also talked about how we've reduced our leverage from about 62% a year ago to about 50% today. And we've also made major improvements in our reporting. So we look at and feel more like a REIT, which makes it easier for analysts to kind of line up our metrics, our valuation metrics. Okay, so just to conclude, the key catalysts, a couple of them we've already achieved. We just syndicated 80% interest in the US multifamily portfolio. That raised $425 million of cash for us, which we use to reduce leverage from 55% to roughly 50% net debt to assets. Again, expect some major third-party fundraising announcements over the next quarter. And that's going to allow us to grow our single-family rental portfolio from about 25,000 to 45,000 homes over the next few years. We're also continuing to generate lots of cash from our for-sale housing, our legacy business, several $100 million over the next 5 years. And lastly, as I talked about, our Canadian portfolio, within a few years, it's going to be an incredible, valuable portfolio that we should be able to unlock or harness the value on.